Now I want to get to what is my favorite way to use divergences, to use stochastics, and that's divergences. So what is a divergence? A divergence is very simple. The market makes a new high, but the stochastics don't make a new high. Or the market makes new lows, but the stochastics don't make a new low. That's a divergence. You see, the stochastics and the price should do the same thing. If one makes a higher high, the other one should make a higher high. If one of them makes a new low, the other one should make a new low. But when they don't, now we can make some serious money. So I'm going to show you two versions here, and this is how George Lane uses stochastics, and I'll never forget. I'm talking to George, and he's explaining this to me, and he concludes, this is exactly what he said. These are his exact words. He says, Courtney, it's damn near infallible. So I said, well, hey, I like techniques that are damn near infallible, okay? I like those for sure. Linda asks, what is the week's close? It's Friday's close. Friday's close compared to the previous Friday's close. All right. So there's two forms of divergence that I'm going to show you. One I call cute. The second one I call mammothly profitable. So let me show you the cute one first, and so you can see what is a divergence. So right here, we got the S&P, or the SPY, I should say. And down here, we have the stochastics, the percent K in black, percent D in red. We're really only going to look at the percent K. So here we see right here in this little section here in the middle of December, the price rallies up and makes a new high. See that? This high, higher than the previous high. We then get a little dip. But on that high, that was the high in the stochastics right here. High in the price, high in the stochastics. They're exactly the same. Now the market dips. This is really important. It's got to go against the trend and then rally up again. And right here is the first day that it closes higher than the previous high close. And we look not at the high and low of the day, but the close to close. So in this case, here's the high close. Here's the next time it makes a higher close after dipping. We look down here and we see that the stochastics on that day were lower than the stochastics on the previous high. So the price made a higher high, stochastics did not. That's what I would call a daily stochastic divergence. Okay, daily. Why daily? Because I'm looking at a daily chart. A divergence because the price made a higher high, but the stochastics did not. Now, write this part down. I now have a prediction. My prediction is that the market will continue higher for 1 to 5 days, most likely 2 to 3, before we have a drop in the market. The market went 1, 2, 3, and on the 4th day, it dropped. Pretty significant down day. So my prediction was right on the money. Let's go take a look at another example, and this one shows something else. So the market then rallies up, makes a new high close. We then dip, and on this day right here, we made a higher close. So I drop down, I see, well, did the stochastics make a higher close? No, they did not. They're lower on this day, at the close of trading this day, than they were at the previous peak. So prices make a new high close, stochastics do not. That's a divergence. So what's my prediction? It's always the same. The price will rally, we'll make a high in 1 to 5 days, most likely 2 to 3 days, and then we'll have a dip in the market, a counter trend move. So what happens? We go 1, 2, 3, 4 days later, the market, well, it's a pretty sharp down move. That one worked great. But the key is, well, let's go take a look over here. Let's look at one more here. Market makes a high close on this day right here. The market then dips. Remember, you always have to have the dip and then rally. So the rally, there's the next close that's higher than the previous close. We don't care about any of these days here. We look at the higher close than the previous close, so the price is making a higher high. We look down here, and the stochastics are lower than they were when the price made a high here. Now, here's the critical thing. Stochastics eventually made a higher high than they did over here. And that confuses people sometimes. The only time you look to see if there's a divergence is the first day that one of them makes a higher high. We look down and we see that the second one, stochastics, did not. Okay? So you look on the first day we make a higher high, not the eventual high. So my prediction would be keep on going up for 1 to 5 days, most likely 2 to 3, and then it'll drop. Here on day 4, the market is dropping. I don't know what happened after that, but here's 3 examples of daily divergence. Now let me answer a couple of questions here before we go on. Stochastic 20, overbought 80, oversold 20, D 3 times slowing. I don't like the word slowing, Raj, because I don't know what that means. I know what it means colloquially, but I don't know what a rule would be. Which one? Simple? It's all simple. They're all simple. These techniques were invented before we could use computers. For divergence, do you first look at the price or first look at the stochastic? I nearly always look at the price. And remember, whenever there's a divergence, you're looking for the price to move in the opposite direction of where it was going. So in this case, we were making higher highs. You're looking for it to start to move down. It was making higher highs. You were looking for it to go down. It was making higher highs. You were looking for it to go down. So you're always looking for it to go in the opposite direction. So I always look for the price first. Ann says the red line is %K and black line is %D. No, the opposite of that. Black is K. Sorry, black is K, red is D. Can we use stochastic 5 instead for swing trading, or will you be getting to it? You can listen. The shorter the time period in the stochastic, the shorter the time period should be of your trading. Now I'm going to show you how to use even this 14-day stochastic divergence for your swing trading. All right. Do you always have to be in a strong trend? It works best if it's in a strong trend, because then it's telling us that the market has gotten exhausted and it's time for a retracement. It's gotten exhausted. The momentum is receding. Time for a retracement. The market's exhausted. The buyers are not as strong as they used to be. The sellers are getting stronger. Time for a retracement. That's really all we're saying. It's no big deal. It's no big deal. Jill says, do you look at the market open when you see the divergence? Nope, just the close. We're only looking at the close. We're not looking at the open, high, or low. Okay, let's take a look. Let's take this further. Let's take a look at another example. But here is where we're going to start to make some serious money. Serious money. Let's see. Eric says to use ADX for the strong trend. You can, but I just look at the chart. All I'm looking for is divergences. So the stronger the better. And guess what? I can use my eyeballs. You could use ADX. That's fine. That's fine. So I'm going to start here because it's a clear picture. I've changed the chart, so now we're looking at General Motors on a weekly chart, okay? And here we have, this is not a strong bull market here, so it doesn't have to be a strong market. It can be a weak market, but we want it to be a bull market or a bear market. So here we have the market makes a higher close. We look down here and we see that stochastics are much lower than they were when the price made its high. So we have a weekly stochastic divergence, okay? Weekly, not daily now, weekly. And I'm going to tell you in a few minutes how to make money from these two things. So we have a weekly stochastic divergence. Here's my prediction. It's a little bit different from the daily. We're going to see the market continue higher for 1 to 5 weeks, most likely 2 to 3, and then we're going to see a major trend change or major counter trend move. Not just a few days down like the daily, but something big, something really big, where we can make life-changing money, where we can build legacy money, where you can make enough money to have a wing on a hospital with your name on it. Okay, you got it? So let's take a look. Here we have the weekly stochastic divergence. You heard my prediction. 1 day later, it makes the high of the high close move, and it then has a major counter trend move. The trends were small here, but we got a major counter trend move. We went from the high, we went down here. That's probably about a 50 to 60% retracement from the low of the move. That's a big move. You can make a lot of money there. This one, kind of a poor example, but let me give it to you anyway. Here we have the low, the red bar, that's a low. Then we go and make a lower low right here, but stochastics do not make a lower low. Same prediction, we're gonna look for a low 1 to 5 weeks, most likely 2 or 3. Then we're gonna see a major counter trend move up or a major trend change. 2 weeks later, we make the low and we get a significant rally here. From the down move, at least a 50% rally here. So that was a really nice signal. And we knew the turn was coming, in this case, 2 weeks in advance. Let me show you a great signal, a great one. We come down here, we make a low. There's the low on the stochastics on the %K. There's the low here. Market rallies. Remember, we always have to have a rally in a bear market. So comes down, rallies up, then comes down again. Comes down, rallies up, comes down. On this day right here, we break to a new low close, but the stochastics are much higher than they were when we made the low, much higher. What's my prediction? You know, 1 to 5 weeks, you got my prediction. Okay, 1, 2, 3 weeks later, we make the low, perfect prediction. And we didn't start a major counter trend move. We started a major trend change. That is a monster trend change. We went from 14 to 56 after this signal. Now, if you can't make money after that signal, you got other problems, all right? So these were pretty good signals. These were major counter trend moves. This one was a major trend change. Okay, let's take a look over here. You can see here we make a high close, we make a higher close, stochastics are lower. Don't know what happened, but I would say probably a significant counter trend move. All right, let me go and answer some questions. How would you trade these signals? James, I'm going to come back. I'll answer that in just a second. You mentioned looking at the price first. Is that because stochastics is a lagging indicator? Partly, but I look at the price always first. Why would I look at a chart and look at stochastics first? I always look at the price first because I'm looking for other things. So when this thing spikes up here, I see that first, then I come down here. I don't go and look at a price chart and look at the stochastics first. So I always look at the price first. How would I program this as an indicator that signals the setup bar on a chart so I know when to take these? It's possible, Trevor, but it's hard. There's a lot of, it's very easy with your eyeballs. It's much harder to do it with a computer program. Okay, so I don't use it with a computer program. I use my eyeballs because I find it easy to see. Bob, great to see you here. You are only using the %K, is that correct? That is correct. Will there be a replay, Sean, as I said before? No, and in all the emails you got, no replay. We're giving this webinar twice today, but no replay. Okay, now let me just go over here. All right, couple more examples. I'll just go very quickly. Rally, dip, higher close, not higher close here. We get a significant counter trend move. Over here, we break to new lows. The stochastics eventually make a lower low, but not when we make the first dip down. 3 weeks later, we get a major bull market. Over here, same thing, divergence. We get a very, very big bull market as well. This is the S&P. It works on indexes, futures, Forex, doesn't matter. Works the same on all of them. All right, but let's take a look at this. Let's answer James' question. When we trade, we want to be looking at the environment or the context of every trade we do. So my first book was a book in 1979 on seasonality. If I know that we're in a seasonally bullish period, that means I should take bigger positions and I'll probably make more money because that's the environment that the trade is taking place in. If the Fed is easing monetary policy, that's a part of the environment that we don't buy because the Fed is reducing interest rates. But boy, that's pretty bullish. So guess what? I'm going to put on a bigger position. So I put weekly stochastic divergence in the same category as of an environmental factor or a contextual. What's the context that I'm doing a trade in? So let's take a look. Let's take a look at this example here in the middle of the chart. We get the divergence on this day. Remember, I don't know what's going to happen over here. I see the divergence here. The next week it goes down a little bit more, no big deal. But I'm bullish. I'm bullish at this point because I see this divergence and I say I need to be ready to buy. I don't buy when I get the divergence. I get ready to buy. And then what I do is I use another technique. Later, I'm going to offer you the Stock Success School, and our core technique in there is channel breakout. So I would say, well, we'll use channel breakout or trend analysis or one of the other techniques that we teach to get long. But I know that I have to put in my orders right now, and I want to make those orders for a bigger than normal position. If I normally buy 100 shares, I want to buy 150 or 200 shares because this is going to be a major counter trend move or a major trend change. In other words, there's going to be a big move, and that's when the big money is made. Not the little money, that's where the big money is made. That's where the life-changing money is. That's where the legacy money is. So the next week, the thing drops precipitously. So obviously I'm sort of having second thoughts. Well, maybe the divergence isn't going to work. But the following week, we get a big reversal bar up. And then almost every week after that, for a long time, for 4 or 5 months, every week is higher. We then get a little dip, then we go up again, a little dip, and we just keep rallying like crazy. And this is 2019 right here. So what I do is, am I going to buy down here somewhere? No, of course not. I'm going to have a buy stop probably up here somewhere. You see what I'm saying? I want this to prove that it's some type of a bull market. So I use one of my other techniques like channel breakout to tell me when to buy and where to put in a stop loss. The key of the weekly stochastic divergence is now I'm alerted to put on an extra large position so I can make big money. Not little money, big money. That's why this technique is so important. But let's take a look at this. Well, what if it was wrong? What if it just kept on going down? Did I lose any money? No, of course not. Because I'm not buying the dip, I'm buying the rally after the dip. What if this one was wrong? And instead of just a major counter trend move, what if it turned into, it just kept on going down? I didn't lose any money. See, that's the cool thing. I wait for the market to start the rebound. I use the stochastic elbow technique to get me back in. All right. So this is the context. Use other techniques like we teach in our Stock Success School to time your exact entries. All right, let me answer some questions. How do you know when to look at the top of the price bar? I don't look at the top of the price bar. I look at the close. Remember, Trevor, I'm looking close to close, never high, low, or open. You look at the close and you're saying, is this close higher than the close on the peak? No. Is this close higher than the close on the peak? Yes. Now I have a higher close. I look down here, stochastics are way below where it was here. It's that simple. Close to close, it simplifies everything. This is a 14-day, all the stochastics I'm going to show you are 14-day. It just comes, you don't need to set it up. Every chart services starts out with a 14-day. You really don't have to do anything at all. And as I said, Eric, you can use this on futures, Forex, stocks, doesn't matter. Abdul asks, is there a way to identify oversold point when the stochastics is above 80? Well, like I say, I mean, look, I should have shown you this one here. We rally up, we dip, we rally up, we make a new high, and we have a stochastic divergence, and COVID comes. In March of 2019, I put out a special report called Financial Crisis. And I predicted in that report that the market would collapse in March of 2020. I said about a year later. Then we saw this stochastic divergence, and I sent out an alert to my customers saying, hey, this looks really bad. The fundamentals that I predicted a year ago say we're going to have a crash, and now we have stochastic divergence. We could have a major counter trend move or a major trend change. Obviously, it was a major trend change. So look for the divergence, not the overbought or oversold. Abdul says, yeah, that's right. Yeah, Abdul, at the very beginning, I talked about how not to use stochastics, and that is to not use overbought or oversold. You're going to get in trouble if you do that. Oh, okay, all right. Spencer, who's on the earlier webinar this morning, says that cleared up so much earlier from today. You know what, Spencer? I do get better the second time I do these things. All right, Erica says, so the direction of the divergence doesn't matter. That's correct. If the divergence is on the downside, you're going to get a bullish move. If it's on the upside, you're going to have a bearish move. It's going to be a move against the trend as it is. Yes, this is 14 weeks. This is 14-week chart. How do you determine the trend direction? If we're making higher highs and higher lows, it's a bull market. If we're making lower lows and lower highs, it's a bear market. That's the definition of a bull or a bear market.